Housing affordability just improved for first-time buyers. At least, that's what the headline says. But there's one number buried in the report that tells you why millions of people still can't buy a home. And it has nothing to do with mortgage rates. Let me tell you something that might confuse you. According to Nationwide's latest analysis, housing affordability has genuinely improved for first-time buyers in the UK. House prices have been subdued relative to earnings. Mortgage rates have come down from their 2023 peak. And the typical first-time buyer mortgage payment as a share of take-home pay? It's moved back toward long-run norms. Around a third of income. That sounds like good news. Finally. After years of pain. After years of being told, just save harder. After years of watching the ladder get pulled further away. Relief is here. Right? Not so fast. Because here's what the headline doesn't tell you. There's a massive gap between two types of affordability. And until you understand that gap, the whole housing market makes no sense. Let me explain the difference. Because this is everything. First, there's monthly affordability. That's the question. Can I afford the payment each month? If you earn a decent salary, and mortgage rates have come down, and house prices haven't gone crazy, then yes, the monthly payment might look manageable. On paper. In a spreadsheet. When you do the maths. And that's what's improved. But then there's entry affordability. That's a completely different question. Can I actually get in the door? Do I have the deposit? Can I pass the stress tests? Can I get the lender to say yes? And this is where everything falls apart. Because you can afford the monthly payment, but still be completely locked out. Not because of rates. Not because of income. Because of the deposit. The upfront cash. The barrier at the gate. The wall that stands between you and ownership. And that wall hasn't moved. So how big is this wall exactly? Let me show you the number that Nationwide buried in their report. And it's brutal. Right? Let's talk about the actual number. Nationwide estimates that a 10% deposit on a typical UK first-time buyer home is around £23,000. £23,000. Now, that might not sound impossible if you're earning well. If you've got a partner saving too. If you've got family who can help. But for most people, that's an enormous amount of money. And here's the really brutal part. Nationwide calculates that even if you save 10% of your net pay every single month, it would take nearly 6 years to reach that deposit. 6 years. And that's assuming your rent doesn't go up. Your bills don't go up. You don't have a car breakdown. You don't have a health issue. You don't have any emergencies. You don't have a life, basically. 6 years of perfect saving. No slip-ups. No surprises. Just grinding away at a number that keeps feeling out of reach. And if you're in London? Forget it. The timeline is even longer. The deposit is even bigger. The maths is even more broken. This is where the market psychology kicks in. Because right now, January 2026, there's a green light narrative emerging. Rates are easing. Wages have been growing faster than house prices. Headlines are talking about recovery. First-time buyers are being told, this is your moment. But the deposit wall means something different is happening underneath. The market can look better, but still feel stuck. Because even if you can afford the monthly payment, you still need to get past the gate. You still need that £23,000. You still need years of saving. Or help from family. Or luck. And without that, you're just watching. Browsing Rightmove. Saving what you can. Hoping the numbers eventually work. This is how a housing market can show improved affordability in the headlines, while transactions stay thin on the ground. Because the real throttle isn't the interest rate. It's the upfront cash barrier. And until that changes, millions of people remain locked out. No matter what the Bank of England does. But here's where it gets even more divided. Because in this market, where you live changes everything. And if you're in London, mate, the numbers are something else entirely. Let's talk about London. Because when Nationwide talks about national improvements, they're averaging out two completely different realities. Outside London, things have genuinely improved for some first-time buyers. In the north, the Midlands, parts of Wales and Scotland, prices are lower relative to earnings. Deposits are smaller. Monthly payments are more manageable. It's not easy. But it's possible. But London? London is a different country. The average first-time buyer property price is dramatically higher. The deposit requirement is dramatically higher. The share of take-home pay going to mortgage payments is dramatically higher. And the timeline to save that deposit? Even longer than 6 years. Maybe 8. Maybe 10. Maybe never, without help. I've seen threads on Reddit where Londoners are doing the maths. I earn £40,000. I've saved £11,000. How far off am I? And the responses are blunt. Nowhere near enough. You need 10% deposit plus a high salary. Have you considered leaving London? That last one comes up a lot. And it tells you everything about what's happening. People aren't just being priced out of home ownership. They're being priced out of geography, pushed further out, commuting longer, or giving up entirely. This is the uncomfortable truth. The UK doesn't have one housing market. It has two. One market where affordability is genuinely improving, where first-time buyers have a real shot, where the numbers actually work. And another market, London and the South East mostly, where entry is still blocked, where the deposit wall is massive, where even affordable monthly payments require wealth you don't have yet. And when you average those two markets together, you get a headline that says affordability improved. But that headline hides the divide. If you're in Newcastle or Sheffield or parts of the Midlands, you might be reading this thinking, actually, I could buy now. If you're in London or the South East, you're probably thinking, none of this applies to me. And you'd both be right. That's the split. That's the reality. That's why national headlines can feel completely disconnected from your actual life. But there's another factor here. One that doesn't show up in any official data. And it's quietly dividing this market even further. Let's talk about the thing nobody wants to say out loud. When we talk about first-time buyers, we often imagine young people saving up, working hard, making sacrifices, eventually reaching that deposit. But increasingly, that's not how it works. For many first-time buyers who are actually getting into the market right now, there's another factor. Family wealth. The bank of mum and dad. Grandparent contributions. Inheritance advances. Gifted deposits. Not loans. Gifts. Money that bypasses the 6-year savings grind entirely. And this is where the market quietly divides even further. On one side, you have people with family help. They can move faster. They can bid higher. They can access better mortgage deals because their loan-to-value is lower. On the other side, you have people without family help. They're still grinding, still saving, still watching prices, still hoping. And the gap between those two groups? It's not about income. It's not about budgeting skills. It's not about avocado toast. It's about whether your family had wealth to pass down. That's it. This is the uncomfortable conversation. Because when the headlines say affordability improved, the question is, improved for whom? If you have parents who can gift you £20,000, affordability looks very different. If you're saving from zero with no help, affordability still looks impossible. And the data can show improvement while half the population feels nothing has changed. This is how a housing market can simultaneously be more affordable on paper and still completely blocked in real life. Because the improvement benefits those who already have access to capital and leaves behind those who don't. It's not a crash. It's not a crisis in the traditional sense. It's a quiet sorting, a slow divide. A market that works for some and locks out others. And the longer it continues, the more that divide becomes permanent. Your ability to buy a home increasingly depends on your parents' wealth, not just your own efforts. That's the hidden story, the one nobody puts in the headline. But here's where it gets confusing. Because rates have come down. The Bank of England cut. So why isn't demand surging? The answer is surprising. In December 2025, the Bank of England cut bank rate to 3.75%. That was supposed to help. Lower rates mean cheaper mortgages. Cheaper mortgages mean more affordable payments. More affordable payments mean more buyers. More buyers mean a recovering market. Right? Here's what actually happened. According to the Bank of England's Credit Conditions Survey, lenders expect mortgage demand to fall in early 2026. Let that sink in. Rates came down. Headlines turned optimistic. And lenders, the people who actually see the applications, expect demand to drop. How does that make sense? It makes sense when you understand the deposit wall. Because you can make borrowing cheaper. But you can't force people to have £23,000 in cash. You can cut rates. But you can't cut the entry barrier. And that barrier is still there. Still massive. Still blocking millions of potential buyers. Look at the actual mortgage data from November 2025. Purchase approvals, 64,500. Slightly down. Remortgage approvals, 36,600. Up. That split tells you everything. One market is trying to buy. The other market is trying to survive. People who already own homes are refinancing. Shopping around for better deals. Managing their existing mortgages. But new buyers entering the market? That number isn't surging. Because the rate cut doesn't help you if you don't have the deposit. The rate cut doesn't help you if you can't pass the stress tests. The rate cut doesn't help you if you're still 5 years away from having enough saved. This is the paradox. Affordability can improve, Rates can fall. Headlines can turn positive. And the market can still be stuck. Because the real barrier isn't the rate. It's the cash at the door. So what does all of this actually mean? And what happens next? Let me give you the honest picture. Let me bring this all together. The headlines are technically correct. Affordability has improved for first-time buyers. Monthly payments as a share of income are back toward normal. Mortgage rates have come down from their peak. Wages have been growing faster than house prices. That's real. That's progress. For some people. But the deposit wall hasn't moved. £23,000 for a typical 10% deposit. Nearly 6 years of saving to get there. Longer in London. Longer still if you're on a lower income. Much faster if you have family help. And that wall is the real throttle. It controls who can enter. It controls who has to wait. It controls who stays stuck renting. This is why the market can look better in the data, while feeling completely stuck on the ground. Transactions stay thin. Because buyers need more than affordable rates. They need cash upfront. They need deposits. They need access. And access is unevenly distributed. So what happens from here? The Bank of England may cut rates further. That would help monthly payments. But it won't eliminate the deposit requirement. The FCA is looking at mortgage market reforms. They've signaled consultations from early 2026. That might make switching or refinancing easier. But it's not implemented yet. And it won't suddenly give people deposits they don't have. Wages are growing. But the labor market is showing signs of cooling. If jobs become less secure, even fewer people will feel confident taking on a massive mortgage. The honest answer? For some people, especially those with family help or existing equity, the market is genuinely more accessible now. For others, especially single-income buyers, those without family wealth, those in London, the wall remains. Nothing has fundamentally broken through it. So where does that leave us? Better, but still blocked. That's the most honest way to describe the UK first-time buyer market right now. Monthly affordability has improved. Entry affordability hasn't. The gap between, can I afford the payment, and, can I get in the door, remains massive. And that gap is the real story. Not the rate cuts. Not the headlines. Not the optimism. The deposit wall. The 6-year saving grind. The bank of mum and dad divide. The London reality. This isn't a crash. But it isn't a recovery either. It's a quiet sorting. A market that works for those with access. And blocks everyone else. That's the truth about UK housing in 2026. The part that doesn't fit in a headline. If you're in the UK, I'd love to hear your story. Are you grinding toward a deposit right now? Have you made it onto the ladder recently? Did family help make the difference? Are you in London feeling completely locked out? Tell me in the comments. Because the national data only tells part of the story. Your experience fills in the gaps. Subscribe if you want calm, evidence-based breakdowns. No hype. No doom. Just the truth about what's happening in UK housing. This isn't the end of the story. But it might be the moment people realize. The ladder has a gate. And the gate has a price. See you in the next one.